to MLD Money Matters, the podcast where we cut through the noise and talk about what really drives markets, portfolios, and long-term wealth creation. I'm Chad Larson, Senior Portfolio Manager and founder of MLD Wealth, and your guide through what's been one of the most dynamic years we've seen the markets in a long time. Today, we're going to walk through our Q3 market summer commentary, what's really happening beneath the surface of this global rebound. And then we're going to shift gears into something brand new, which I'm excited to share with you all today. The AI 2030 Plus portfolio. I'm sure the name might change. Matt on my team has been leading this charge and the kind of the framing of the marketing that we're going to release hopefully this week, if not next. But our strategic framework for investing in the infrastructure behind the artificial intelligence economy. We get a lot of calls from clients all the time about, what is AI? How do we invest in it? The thematic and the tailwinds within the sector garnered a lot of attention and buoyed a lot of the U.S. market through anticipation of call it the AI revolution, similar to what we saw in the Industrial Revolution. But we're going to unpack why we built it, how it works, and why this moment, mid-cycle, not peak, may be the single best opportunity of the decade for disciplined investors. Segment one, guys, market overview, recovery with rotation is what I want to call it. Let's start with the big picture. Global equities rebounded strongly through the third quarter. Growth steadied, sentiment improved, and for the first time in over a year, we saw breadth, real participation across regions and sectors. In the U.S., markets hit record highs. This was powered by fiscal stimulus from what's being dubbed the One Big Beautiful Bill, an infrastructure and clean tech push that continues to ripple through the economy, and by strong AI-driven earnings from the tech and consumer sectors. But the real story isn't just U.S. exceptionalism anymore. It's that Europe and Asia have joined the party. Europe's fiscal expansion, especially on infrastructure and defense, has reignited capital flows into industrials and banks. China, meanwhile, has stepped up targeted stimulus in tech, housing, and manufacturing. What we're witnessing is a global shift from policy fragmentation to coordinated fiscal growth. One of the levers that I've been talking about ad nauseum over the last 10 podcasts is one of the levers that we saw, to continue to drive strong market performance. So the first time since the pandemic, major economies are actually rowing in the same direction. Now, we've been talking about this idea of rotation for months, and this is exactly what we mean. A shift away from narrow US-centric growth towards a broader multipolar expansion. It's not just big tech leading the way anymore. It's energy, infrastructure, and manufacturing all contributing to the story. That's healthy, that's durable, and that's what mid-cycle recoveries look like. Segment two, macro landscape, inflection, not stagflation. Now, if you've been reading the headlines, you've probably seen the word stagflation thrown around quite a bit. Let's call it what it is. Lazy analysis. The data simply doesn't support it. Unemployment has softened a bit, yes, but inflation has cooled meaningfully. And unlike in the 1970s, companies today have flexibility, automation, AI integration, global supply optionality to manage costs and maintain margins. Tariffs are a drag on growth, not a spark for inflation. And the Fed, they recognize the shift. Cutting rates by 25 basis points in September wasn't just a technical move, it was a signal. A signal where entered the inflection point, the transition from tight policy to supportive policy. That's critical for investors. It means that the policy backdrop, which for 2 years was a headwind, has finally become a tailwind. In other ways, the runway for the cycle just got longer. And this cycle is different. It's not driven by cheap money and speculation. It's driven by fiscal coordination, productivity gains, and capital investment, things that tend to sustain, not collapse expansions. Segment three, policy and positioning, from tightening to tailwinds. Governments around the world have pivoted. In the US, fiscal stimulus and deregulation are sustaining private investment momentum, particularly in manufacturing, clean tech, and AI infrastructure. In Europe, we're seeing a remarkable shift towards industrial policy, infrastructure renewal, and defense spending, areas neglected for decades. In our last podcast, I talked about tactical shifts towards defense. This is working out well, and the breadth of that has continued to run. In China, fiscal and credit support are flowing back into tech and manufacturing. These policy trends underpin what we at MLD call a multipolar global recovery. That's a fancy way of saying we'll no longer depend on one economy to carry the world. Multiple engines from the US to Europe to Asia are running simultaneously. And when that happens, portfolio diversification starts to pay again. And that's why international equities have outperformed for the first time in years. And that's why we're keeping exposure global, not just domestic. Segment 4, market themes, AI and productivity. Now let's talk about the driver that's reshaping everything, AI. Artificial intelligence is not a niche theme anymore. It's the backbone of the modern economy, much like electricity was a century ago or the internet in the early 2000s. The critical difference here is AI is not living in the future. It is being monetized today. We're seeing AI productivity boost productivity across supply chains, customer service, logistics, even manufacturing. Companies are not just experimenting, they're integrating, and the market is rewarding those with real revenue traction. But here's the nuance. AI's value creation is moving down the stack. The next leg of this story isn't just about the algorithms or flashy models. It's about the physical world, the data centers, the chips, the energy, the copper wiring, and the cooling systems that make AI possible. That's where the next wave of capital spending and opportunity lies. So while headlines fixate on ChatGPT or the next big software release, the real investment frontier is the infrastructure of intelligence. That's what brings us to the portfolio we're going to talk about today. So outlook and strategy, we've kind of stripped it back. Constructive but selective is really the mantra. From a portfolio positioning standpoint, our stance remains what I'd call constructive but selective. And the good news is recession risks remain low, inflation is easing, liquidity is improving, and global fiscal policies are finally working together. The caution, valuation in some sectors, particularly mega cap tech, are stretched. So discipline and selectivity matter more than ever. At MLD, we continue to anchor portfolios in 4 key areas that I have discussed previously. Gold as a hedge against policy error and geopolitical instability, international equities to capture fiscal tailwinds abroad, alternatives for diversification and inflation protection, innovation, particularly in AI, digital infrastructure, and productivity driven growth. So I'm excited to introduce this here later. This approach isn't about chasing returns, it's about building resilience into portfolios, the ability to compound through cycles, not time them. So I want to introduce the AI 2030 portfolio. Don't hold me to the name. It's with marketing and Matt on my team to come up with something cool and clever for it. But the reality and the thematic of it, you'll understand here. This is something we've been quietly developing for months, and it represents our strategic blueprint for investing in the real economy of AI. The portfolio is live. I've seeded it personally. It's been running and tested and has proxies enabled and has gone through a rigorous construction and analysis phase. And we're excited to be delivering it to existing clients here shortly. So let's start with the philosophy. We're mid-cycle, not at peak. AI investing is surging, but this isn't the dot-com bubble. This is becoming an infrastructure boom. There's real adoption, real revenue, and real capital expenditure across the stack. My goal was simple: build a portfolio that owns the enablers of this transformation. This means companies that supply the compute power, firms that generate and distribute electricity, and producers of critical materials, copper, lithium, rare earths, uranium, that physically enable AI's expansion. This is not a tech theme. It's a macro to micro positioning strategy for the next decade. Let me break down the structure. Number one, and listen, if you become an investor in the portfolio, there's a whole bunch of other data and information and portfolio supporting thesis that we will provide to you. So I'm not going to get into the nitty gritty of the portfolio construction today to bung this up with compliance. But number one, about a 25% weight of the portfolio is upstream, AI, compute, and semiconductors. These are the core enablers. They're the picks and shovels of the digital gold rush. They're sitting at the heart of global AI compute, capturing margin across every data center expansion. Midstream energy infrastructure, about a 12.5% weighting currently within the portfolio. These are the pipelines feeding the AI economy. As data center power needs surge tenfold by 2030, natural gas and LNG become essential bridge fuels. Regulated utilities are making up about 12.5% of the portfolio. These are firms that are signing long-term power contracts with hyperscalers like Microsoft and Google. They provide stable returns, dividends, and exposure to the electrification build-out. Nuclear and uranium, about 15%. This is the clean baseload power story. AI runs 24/7. And only nuclear can meet that kind of demand with zero emissions. Commodities, about 25% of the portfolios, as spread across copper, lithium, and rare earths. Copper wires every data center, lithium power storage, and rare earths drive cooling system and turbine magnets. And then there's about a 10% cash and liquidity sleeve acting as dry powder and a volatility buffer. Altogether, this forms a 60-40 blend, 60% growth exposure and 40% stability in income. It's a full stack approach to the AI economy, from semiconductors to power grids to raw materials. It's not about chasing hype, it's about owning scarcity. I want to talk about why we built it. So why did we build this? Because the world has changed. A traditional 60-40 portfolio of stocks and bonds doesn't capture the new sources of return, especially in a world driven by AI, energy transition, and electrification. We needed a tactical weighting framework that adapts as cycles evolve. This means rebalancing dynamically between semiconductors, power and materials, capturing secular growth while maintaining yield, inflation protection, and downside resilience. This is where MLD's active management shines, because unlike most advisors, we don't outsource all of our portfolio construction. We manage it directly. As you know, I'm also the portfolio manager of the MLD Core Fund, and I take full accountability for risk and return. The MLD Core strategy, which is a prospectus cleared fund, has delivered over 23% in the past year and over a 10% annualized return over the last 5 years, ranking consistently in the top decile of Canadian Tactical Balance Fund, beating all of its benchmarks. So when we launch a strategy like AI 2030, it's not conceptual. It's built with institutional rigor, tested frameworks, and full alignment. This is investing, not speculation. Segment 8, I want to talk about access and alignment. This is I wouldn't call it pivot, but an evolution of MLD Wealth. MLD Wealth, I started this 21 years ago, and we've seen incredible growth. I'm so proud of what we have built, in partnership with our firm. It's just an absolute blessing to what we have created, and the wonderful, incredible families and private clients that we've shepherded through various markets over the 21 years are the backbone and of what we do and what gets us up every morning. But as we look to create true enterprise value within the MLD ecosystem, I took a page out of one of my colleague and partners' books, that has done this already. And so, the AI 2030 portfolio is going to be available right away to MLD private clients within our discretionary platform. And I'm excited to bring that and allocate selectively for select clients that it makes sense within their portfolio. But for the first time, we're opening the access to non-MLD investors outside of our multifamily office structure with a pay-for-performance incentive. We win when you win. But under this model, you can ensure that our service and commitment to private clients remains intact, as investors in our MLD AI 2030 plus portfolio are not going to gum up our time and focus on your family. So if you're listening to this and you're not yet an MLD client, or you know someone who's passionate about AI and infrastructure and this next great cycle, this is your invitation. Tell your family, tell your friends. So the AI 2030 portfolio is your chance to participate directly in the build out of the next AI revolution. So, the bigger picture, let's zoom out for a moment. AI is not a single theme. It's a structural transformation that touches everything, as I've mentioned: energy, compute, infrastructure, productivity. Power and material are the real limiting factors going forward. And the companies that solve those bottlenecks, the ones that deliver electrons, wafers, and raw inputs, will command the next decade of value creation. The best opportunities don't live where everyone is looking. They live at the intersection of demand and scarcity, and that's exactly where we're positioned. So, as we close this, remember this with respect to, what I've kind of tabled, hopefully given you some insights into Q3 and our four, main thematics. But I wanted to just remind you, within the idea of AI, is that we're mid-cycle, not at peak. This is a time to stay invested, stay selective, and stay disciplined. The global economy is transitioning from fragmentation to coordination. Fiscal investment, improving productivity, and easing policies are setting the stage for a multi-year expansion. At MLD Wealth, we're here to help you navigate that, to turn macro insights into actionable, risk-managed portfolios. I'm Chad Larson. Thank you for joining me on MLD Money Matters. If you enjoyed this episode, share it with a friend, subscribe, and stay tuned for the next month's conversation, where we'll dive deeper into the markets. Until then, stay resilient, stay informed, and stay invested.